Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
David Lebovitz of JP Morgan writing this: as inflation gradually moves lower, so too should the federal funds rate. We still expect 2 cuts this year. The biggest risks are at re-acceleration in wage growth or some sort of government policy that reignites inflation. David joins us now for more. David, good morning.
Morning. How are you?
How excited can we get about the last 24 hours?
So I think it was more of a market breathing a sigh of relief as opposed to new information. I mean, what we're seeing is that we're making progress on inflation, but it's the services component that's particularly sticky. And when you break that down even further, where the heat is really coming through is in shelter and then transportation services. It feels like the auto insurance issue is in the process of running its course. Shelter should continue to soften. Where that leaves us is the biggest risk being that if wage growth begins to reaccelerate, that's going to show up in things like food away from home, that's going to show up in services more broadly, and that's really the risk to the Fed adopting a significantly more hawkish tone than they have up until this point.
Yesterday, both stocks and bonds rallied. Do you want to chase either?
So the positive correlation thing is tricky, and we spend a lot of time talking about that because in a perfect world, we'd end the year with stocks higher and rates lower. You know, how much lower can we really go on rates given where the Fed is and given where inflation is? I think that's the big question. You know, we're definitely leaning more into the risk side of the trade as opposed to the duration side of the trade. But I will say with the curve now, you know, positively sloping, you're getting a little bit of carry for being long. Duration doesn't look quite as problematic from a portfolio construction standpoint as it had been when the curve was inverted and you were basically having to pay to be longer out on the curve.
Can I ask, in the curve and the shape that it's doing and getting more steep, there's been a lot of commentary that it's people concerned about fiscal deficits, that it's concerned about the economy. But to some degree, David, this is just normal. This is how things were before the GFC. Is there any element of what we're seeing actually a good thing and a return to some sort of normalization in the yield curve?
So, I mean, fundamentally, having a positively sloped yield curve and having a base rate that isn't zero, I think, is very healthy for economies broadly. What I think is particularly interesting about where we are today and the move that we've seen in long rates over the past couple of weeks is really that it is being driven by those concerns around fiscal policy. If you look at the relationship between the 10-year yield and the economic policy uncertainty index, if you look at what's been going on with the term premium, right, all of these are moving higher together. And what that says to me is that the bond market is concerned about something more than the expected path of Fed policy. If we get one cut this year, you know, 465, 475 on the 10-year is pretty much fair value. We would need to see the Fed engage with hikes to get to that 5% number, or we would need to see something on the fiscal front that just causes that concern amongst bond investors.
So some of that is the uncertainty premium. As you watch things like Scott Bessent's nomination hearing, as we go through the inauguration and you get different executive actions put in place, what is actually tradable and what just leads to more uncertainty?
So I think it's a question of signal and noise, and I think that the order of operations is going to matter quite a bit here. I mean, my sneaking suspicion is that when President Trump comes into office next week, the first thing he's going to do is unwind a lot of the things that the Biden administration had put into place. So that's step one. Step two is he moves on and begins to pursue his own agenda. We do think he's going to lead with immigration and tariffs, so we may get some of the more punitive stuff first. But on immigration, I think it's going to be a little bit more thoughtful than people are currently expecting. And on trade, I think that this is the beginning of a great negotiation. You know, the news that's come out around tariffs kind of ebbs and flows, and, you know, somebody says one thing and then it gets walked back. I think that tells us a lot about what we should expect in terms of the evolution of trade policy going forward.
So it's used as bluster to get Xi Jinping basically to the table with this maximalist approach, but maybe he actually won't follow through on the maximalist approach. Is that your base case?
Exactly. I mean, if you look at where the United States gets the majority of its consumer electronics from, it's China. We're not going to put a 60% tariff on consumer electronics. Half the reason that Trump's going to be in the White House is because the Biden administration oversaw a period of elevated inflation. And so you have to kind of weigh those forces together and get a sense of, you know, I think he's going to shoot it pretty straight down the middle, but there's going to be a lot of volatility along the way. And that's what we're trying to remind our clients.
That idea keeps coming up in a lot of conversations I have, that inflation is really important for this incoming administration to make sure they're getting down, and that's partially why they won this election. But there is potential that some of what Trump is talking about is inflationary, and you still have 2 cuts priced in for 2025 in the team. How do you weigh both of those?
So I think, first of all, it's important not to put the cart before the horse. And, it was just, 4 or 5 months ago when we were triggering the SOM rule and the economy's going into recession.
A year ago, we had 6, so
markets are still somewhat twitchy. I think the reality is that the broader trend in inflation is lower, and the Fed clearly views the current level of the Fed funds rate as being restrictive. So they remain on a path of more easing. How quickly that easing materializes, to me, is the bigger question. People were talking about March and June and then done. I think we might see first half, second half done, but we're not going to cross that second cut out until we have information that inflation isn't coming down the way that the Fed would like to see. With respect to the interaction with the policies coming out of the White House, tariffs are a one-time level shift. And so we don't really view that, unless it becomes truly tit for tat, as being a source of inflation that the Fed is going to focus on. Immigration could be somewhat inflationary, but I think that takes time to play out. If you look historically, inflation does come in waves. It tends to be a first wave, a pause, and a second wave. To me, if we get that second wave of inflation, and I think it's still a big if, much more of a 2026 story than a 2025 story when you have those tax cuts coming through, when you have more progress on deregulation, and when you have some of these inflationary policies finally working their way through the system and beginning to show up in the data.
Absent a breakdown in the labour market, should the Fed's bias just be to wait? Why would they cut at all, given everything you've just said?
So I think that the reason that they should cut is because, again, if you look at the real Fed funds rate, it is somewhat punitive. Also, when you look at a broad mosaic of labor market data, the 250 payroll gain we got last week doesn't exactly line up with a lot of the other
So you're
data
not buying
points.
the 250?
I'm not buying the 250. I'm buying the fact that the quits rate has been stable and relatively low. And I think that tells you everything you need to know, because if you're not able to walk out the door of your building, go across the street and get paid 20% more to do the same job, that tells you a lot about the state of the labor market. So look, the labor market's healthy, 4% unemployment, 4% wage growth. This is all really good stuff, but I do think on the fringes, you're seeing that softening, and that is what is causing the Fed a bit of concern in this environment.
If you had to take a bet, if you were thinking about how this labour market might break, a re-acceleration or a real deceleration, are you betting on the latter and not the former?
I do think that the risk is still to the upside. This is a very healthy economy. Real income growth remains positive. We have the prospect, if we get this deregulation, if you get, more favorable tax treatment, you could see CapEx begin to tick higher. And that's one of the more cyclical parts of the economy. And so, the engine of the car, being the consumer, looks completely fine. Is it going to get turbocharged by some of these policies? I think that's probably a risk that we can't dismiss.
I find it really notable that the thing that continues to be consistent is that quits are lower, it's getting harder to find new work, and you're seeing wage growth stagnant. If you don't trust the headline data, should we just continue to look at that? Does that need to be our guiding star in this economy?
So that's why I was so surprised on Friday, and everybody was freaking out, 250,000 jobs. I'm like, guys, wage growth is coming down. I mean, isn't that what really matters when it comes to inflation? It's not the number of jobs you're creating, it's the amount of money that's going into people's pockets. And furthermore, the data from the Atlanta Fed yesterday that breaks down wage growth by income quartile showed that those lower income individuals are finally seeing wage growth begin to slow. And that's important because those are the individuals with a higher marginal propensity to consume. They spend every dollar that comes into their pocket. So that's really what can cause the delta when it comes to things like growth and inflation.
Peter Scheer of Academy Securities made this exact same point the other day, but he went on to say that his concern is that the Fed is paying attention to the headline data, that the Fed is reacting to data points that might be skewed. Do you share that concern?
I think that the Fed does a very good job of looking at a broad mosaic. I mean, they have a staff of economists that are spending time on all of this stuff. Yes, they're not going to fade the 250 number because there could be a signal, but it could also be noise. And so I think they'll continue to just look at what the data more broadly is telling them and try to square that with their own forecasts when coming up with the appropriate trajectory for monetary policy.
If the data is so noisy, should we just do what Mohamed El-Arian told me to do ages ago, which is listen to the CEOs? This morning, BP cutting 5% of the workforce. Yesterday, we had headlines from Microsoft, from Meta, from Southwest. Are these idiosyncratic, or is there a trend?
I think for the time being, it's somewhat idiosyncratic. The calendar turns, beginning of the year, a little bit of cleaning out the closet, if you will. But I think we need to watch these developments quite closely. And again, coming back to the quits rate, part of what gives me comfort about the labor market is that the quits rate is low, but the layoff tariff rate is also low. And if we begin to see that trend higher in a more material type of way, that's when I think you may see the Fed begin to express a bit more concern about the growth side of the equation and fade some of the inflationary pressure.
We won't discuss return to office policy, don't worry. David, it's good to see you. David Lebovitz there, JP Morgan. David, thank you. Let's speak to a man who can settle things down. The former Fed Vice Chair, Richard Clarida, joins us now for more. Rich, good morning.
Glad to be here.
It's good to see you, sir. Let's start with the economic data, not just this morning, but of the last 24 hours. Does it change much for you?
Well, you'd like to get some good news on inflation occasionally. We've had some negative prints, and so I think it was a positive. Inflation's still running, I think, hot, but the Fed will be looking for a return to getting on that bumpy road down to 2%.
Do you think the trend is uncomfortable, or are you comfortable with the trend right now?
I'd be a little bit nervous. The Fed put a lot of weight on the fact of seasonals a year ago. Well, we had 3 bad months of data. The last 2 or 3 months of 2024, the data wasn't going in the right direction. So I do think we're on a path to 2%, but the road may be bumpier than folks thought a couple months ago.
To that point, it's been this narrative whipsaw. It's been back and forth. It feels like we're either scared it's going to be a recession or the economy is running too hot. Do you believe that the economic data is actually that uneven, that we can have such different turns in the narrative just 1 month apart, or is something else going on?
I think it's both. I think we've been through a very unusual period. We've had a lot of aftershocks from the pandemic, including inflation. We've had a lot of good news in the U.S. Very strong productivity growth, a big increase in wealth, and obviously the Fed is happy that inflation has come down. So I think there is sensitivity and probably a little bit about what to expect for fiscal policy and how will the Fed react.
To that point, should we be looking all of this data at this moment just as a starting point of what we might get from policy that might add to inflation, might change growth dynamics? Is that the right lens to view everything we're getting?
I do think it is. Initial conditions are important. And so, beginning the year, the economy is growing above trend, 3%, low unemployment rate. And so I think putting policy uncertainty in the context of where the economy is, I think, where the markets need to be.
Should be what the Fed is doing as well?
Oh, of course. Oh, everywhere and always about the Fed, right.
Well, to that point, how forthcoming should they be? And that's their estimation, that they're looking at the current data and saying, we understand where it is, but we need to preempt where it's going because of fiscal policy.
Great question. And I do think that Jay Powell made the case, especially in November, that they're not inclined to get too far ahead. There's a lot of uncertainty on the details, tariffs, taxes, immigration policy. And I think we are at a delicate point for the Fed because the minutes reveal they did start to incorporate some views on that, but I don't think they'll get too preemptive in this environment. I don't think that would be worthwhile.
Well, in November, Powell said we don't assume, we don't speculate, we don't guess.
Good quote, yeah.
But then in December, members did.
Yeah.
So how are we supposed to understand this?
Well, the minutes were very revealing and more so than usual, I think, because in fact, if you read carefully, as I'm sure you all did, not only did participants on the committee begin to pencil in some views, but the staff briefings also looked at scenarios for trade, tariff, immigration policy, but also incorporated some of that into the baseline. So they're already starting to try to factor that into the forecast, but I think with a great deal of humility.
You talk about how uncertainty is the only thing certain.
Yeah.
What are you most uncertain about when it comes to Trump 2.0?
Well, I think you look at the 3 priorities of the administration. What are the details on tariffs? Is it a bargaining chip? Is it a battering ram? Immigration policy, I think bipartisan support. We need to fix our immigration system, but the details will be important. And then the budget, obviously. I think everyone agrees, including PIMCO, that the 2017 tax cuts are going to be extended. But will there be additional tax cuts? Will there be pay-fors? How much of the Biden agenda will be reversed? And so I think you need to look at all 3 of those.
You're in the perfect seat, because the other question as well is whether this bond market will constrain the ambitions of Washington, D.C. How are you and the team thinking about those forces?
It's very important. We were having some conversation before I came on about the bond market vigilantes, the idea that if Washington's running an irresponsible fiscal policy, you push up rates, you push up term premia, and I think that'll be a very important part of the calculation. Now, bond yields can go up not just because of budgets, because of strong growth and optimism about productivity. So the Fed will have to do some signal extraction, but I think importantly, if yields sell off because Washington's running an irresponsible fiscal policy, then that's part of the way the economy needs to adjust.
What do you think the run-up in bond yields more recently has been about? The data or the incoming administration?
Well, I'm going to be the proverbial two-handed economist. I think there's an element of both. I think that there's optimism about growth, about deregulation. I think that's certainly an element of it. But there's also, I think, concerns about fiscal policy. And we saw that a year ago, and we could be seeing some of that right now.
But you've been writing that bonds are better positioned in 2025 than other asset classes. Does that mean that run-up in yields reverses? Is there going to be a catalyst to help bring us back closer to the ground?
Yeah, so our thinking is that bond yields obviously have been in a range. They've been fluctuating. But we saw bond yields reach 5% about 14 months ago, and then they retraced down. We do think there is an enormous global appetite for treasuries, and there will be a certain level of yields. Last time it was around 5%, where you start to get a lot of foreign demand. And so one of the reasons that we're bullish on bonds, in addition to being PIMCO, is that starting yields are historically the best single predictor of your return on a quality bond portfolio. And starting yields now are attractive and obviously have room to adjust lower under the right circumstances.
John and I have been talking about this hour how it's getting the notice of not just individuals that are part of Trump's economic policy team. J.D. Vance talked about the 10-year yield twice over the weekend in an interview that wasn't even supposed to be financially focused. Yeah. Is there a level that you think, and I mean, Donald Trump, that really starts to unnerve him?
Oh my goodness. Well, I wouldn't speculate on that. What I would say that markets would be focused on, let's sort of simplify it, is, the peak in 10-year yields so far in this cycle has been 4.99%. I think maybe for a minute we got above 5. So certainly if rates, 10-year yields broke above and stayed above 5, that would get a lot of attention around the globe, in the White House, and at the Fed, and in markets.
Can you help me with something? Because I've got a little bit of a dilemma. I'm trying to figure this out. You were on the Federal Reserve back in the early 20s. So the end of 2021, I've got the minutes in front of me. I've got the SEP in front of me too. Yep. December 21, the outlook for the Fed funds rate, the median for 22 was 0.9. Yeah. And you ended up hiking interest rates all the way up to 4% at the end of 22. Yeah. And this was after President Biden had already unleashed stimulus into a supply-constrained economy. This was after even inflation was climbing up to 5%. The Fed sat there at the end of 21 and said, maybe rates get to 1%. And I'm looking at the range of estimates as well on the FOMC. It's really narrow too. It's anywhere from 0.4 to like 1.1. So it's not like there was some outlier there pricing in a policy change in Washington. Why does it feel different this time with Trump coming back into power? Why was this Federal Reserve and some officials more willing to adapt their outlook, adjust their outlook on policy changes from Donald Trump when they were unwilling to change, even though they'd seen what was coming from Biden? What explains that, Rich?
Well, look, in my own writings and on this show, I've talked about, what at least I was thinking in real time. And certainly by that point in 2021, the Fed had realized that it needed to begin to end QE to start signaling rate hikes. I think there was also an assessment as well about, on the committee, and a range of views on the committee, I'll leave it at that, about how transitory inflation would turn out to be. So there's no doubt that in retrospect, the Fed would have been better off beginning to hike rates in the fall of 2021. I think what you need to look at is September versus March of 2022, you need to look at the result and well-anchored inflation expectations. But it was a challenging time, John, not just for the Fed, but also for central banks around the world. The pandemic, the shocks, and the policy response, it was difficult to navigate through.
I think we all just want to be sure that it was just an analytical mistake and not a consequence of political bias.
Oh, I'm certainly not in my judgment, a consequence of political bias.
Because it is odd that in November the chairman says one thing and then in December he has to say another. And I'm still struggling to explain to people just what changed in between.
Well, again, it was a rapidly evolving situation in terms of the data and in terms of the assessment of the economy. And again, the Fed only meets 8 times a year, so a lot happens in between meetings as well.
Rich, appreciate your time.
Thank you.
Always fantastic to catch up. Richard Clarida there, the former Fed Vice Chair. Francis Donald of RBC disagreeing, writing, RBC Economics is no longer calling for any more rate cuts in 25. And the reason is simple. In our base case, the data simply won't give the Fed enough justification for further easing. Francis joins us now for more. Francis, good morning.
Good morning.
Did CPI yesterday change the story at all for you and the team?
No. Inflation is going to move downwards, but it's not going to get below the Fed's target. And more problematically, what is the balance of risks in the later part of this year? Everything I've heard about in the last 24 hours, the CPI was marginally below consensus. It's a game changer. First of all, the data was not a massive game changer in and of itself. But here's the issue, John. If we were just looking at a normal economic cycle, that would be one thing. We'd say, the economy's behaving like it's mid-cycle. This is the trend in jobs and inflation. But we know that there are these exogenous shocks that are going to disrupt the cycle that we're currently in. We don't know the probability and we don't know the size of them, but we know that they are coming. So where we are in December or January or February is far less important to the Fed call or the longer term market call than anything we find out next week when President Trump takes office and we start to get more of a sense of the sequence of his policy, the size and the scope of the policies ahead.
We've said it repeatedly on this show with guests, with yourself, the most important data point this month, perhaps this year, is Monday. It's inauguration. When you think about sources of inflation, and we had this conversation yesterday on the show, labour, energy, goods, services, where we're set up right now, where do you think we are most inflation prone when you start to think about policy changes?
So the inflation story is actually fairly simple. Goods are no longer going to be deflating. We know that housing is short on supply, so that OER number is going to keep a floor underneath it. And we got a heck of a ton of fiscal spending and the lagged effects of prior fiscal spending that's going to keep services alive. The labor market just doesn't have enough people. It'll have even fewer people moving forward. So that's the state of play where we are now. Now the challenge is some of the policies that we know could be coming forward actually are disinflationary, things like deregulation or any policies that help you increase productivity. But things like tariffs and immigration reform, those policies actually will increase inflation, and the magnitude depends on things like how does the US dollar move and other factors surrounding it. So the sequencing of effect, we've talked about this before, the sequencing, do we get the disinflationary ones first or the inflationary ones next? That's going to be really important for 2025, but looming over this more normal cycle that we're entering for the Fed is the threat of these disruptors that are coming through, and on balance, we see them as being more problematic for upsides to inflation than downsides.
Well, we know some number of Fed officials take that into account. How willing do you think the Fed is going to be not reactionary, but be preemptive when we understand some of the policies coming from Donald Trump?
Well, historically, they've told us we don't do that. We wait for the actualized policy to come through. And Chair Powell has been very clear. We actually want to see realized data and just how tariffs filter through into the economy. We're still learning. We got a little bit of experience. Economists know a lot about washing machines from 2018. We know about steel and aluminum tariffs. And we know that some of the currency can actually provide an offset, and how retaliatory other countries are also matters as well. So there are too many factors when it comes to modeling how a tariff impacts inflation for the Fed to respond proactively. But we've already heard them. We've already heard them through their balance of risks in the SEP, through some of them already incorporating that they know the risk of a tariff is not that it creates deflation, but that it creates inflation. Meanwhile, the labor market, it's looking kind of tight, even though there are some particularities, like layoffs are very low, but hiring is also very low. There's some really interesting things happening there. And this is a Fed that's going to be very aware, the market needs to get up on this, that this is going to be a supply-constrained labor market, so you're not going to have a significant increase in the unemployment rate, even though there may be some interesting factors under the surface there.
Personnel is policy, and today we're going to hear from a key personnel from the Trump administration, incoming Trump administration, that's Scott Bessent. What do you want to learn from him as an economist?
I want to understand the magnitude around some of these themes. So are we talking about things like 25% across the board tariffs, or are we talking about selected industries? And this is really important if you're trying to model these types of developments, because we're trying to figure out what are the primary industries that are hit and then what are the secondary knockoffs. We're probably not going to get that detailed policy. And this is the really core component to the uncertainty tax that will weigh on the U.S. in the next few months. One thing that I do expect is a combination of uncertainty, really slowing a lot of decisions, but then also some inventory hoarding. We saw that before. When you expect the price of something to go up, or you're an industry that suspects maybe I'm at risk here, could actually see inventories rise. So there are so many underlying factors, and what's so critical is these are not typical cyclical developments. So your typical cyclical economic model is not helping you here. You're making an excessive amount of assumptions that are coming through. We have to do some element of that, and that's why a lot of these base case forecasts that went out in the 2025 outlooks, including ours, appropriate modal forecasts, but to stay wedded to them right now, I think is too dangerous.
Just to put a bow on this, because the inflation, the stickiness that we have seen, a lot of it has been because of demand, that the consumer is still spending, the labor market is still robust. Does that shift, is what you're describing a supply shock? Is that the form of inflation that will take? And what does that mean for the Fed's ability to fight it and our ability to cope with it?
A beautiful question, and this is the most important macro theme for me for 2025. You talked about a bow. Let's put 10 bows on this. The U.S. economy is moving from a demand-led economy, the one that we all learned about in our economic textbooks, the one that created a Federal Reserve that said inflation is too hot. Let's slow the economy with higher interest rates, to one that is much more similar to a lot of the things we experienced during COVID. A labor market that doesn't have enough people, enough of the skills qualifications to fill health, enough of the immigration to fuel the retail, leisure, and accommodation area. This is going to be important to labor. And then on industry and manufacturing, it's not going to be about can we get, or do we want to have those intermediary goods? It's going to be, can we actually access them? So some of the lessons from COVID with different magnitudes are going to be very relevant here. And what's really critical for us is, how does the Federal Reserve respond, not just in the next 3 months or 6 months, but in the coming years, to an economy that is more supply-led and, dare I say, less interest rate sensitive. A little bit of an existential crisis for central banks, I think. We'll see as we go along. Another area of uncertainty, not just what will the data do, but how will the Fed respond to it. Lots of clouds and fog happening right now.
What do you think of how they've managed the message over the previous 2 meetings around the incoming administration?
Well, the challenge is, when I'm looking at a SEP, or I'm trying to understand the Fed's decision-making function, what Chair Powell explained to us is that they're all taking different approaches within the Federal Reserve. So we don't really have a lot of clarity there. One of the challenges for the Federal Reserve is they've been very clear we are data dependent. We want to see what the data does month to month. So then you get these huge outsized moves around things like CPI because of a decimal point off on the month over month. And then guess what we get? Revisions. We find out that there are seasonality distortions. Now we're going to go into January and we have a massive weather event, a horrible tragedy in California that's going to disrupt all my January data. So there is a little bit of danger with the data dependence comment in an era where we know seasonality, revisions, low response rates, and a myriad of other problems create less clarity around the month to month.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.